Welcome to the show, everybody. This is episode 102. And guys, are we going into financial crisis 2.0? Is this a repeat of the GFC from '08? I'm having flashbacks.
God, I hope not. That was the most stressful period of my life.
Hey, but wasn't '09 like your best performing year ever at the fund?
It was, but that didn't mean 2008 didn't suck.
All right. Well, we have no shortage of things to cover and talk about today. Man, just what a wildly volatile week. Bitcoin jumped from 19K up to over 26K in just 3 or 4 trading days. Rates have taken a massive reversal. And Trav, you were saying something like how big of a deviation on the rates?
The numbers don't even compute. Like some people that run the stats were saying a 10 standard deviation move, but a 10 standard deviation move in markets should happen like once every million years or something. So I think the data set needs to be reworked, but certainly by any measure, the size of the move in rates has been just absolutely enormous.
Yeah. Just a few days ago, the story was, oh my God, inflation, bond rates going through the roof, stocks dumping, what's happening to Bitcoin, right? And then just in the span of a few days over the weekend, the entire picture changed. And we had the 3 big S's, the 3 banks, go under or get attacked, or, we'll jump into that. Actually, the other day, you guys Nikki and Travis did an interview here on Nikki's channel at She Talks Finance on YouTube. Go check that out. But this was about a 45-minute conversation you guys had about, is your bank about to fail? Do you guys want to give a quick recap or maybe some actionable tips before someone goes to watch the full interview?
Yeah, I mean, that interview, basically, Travis was kind enough to break down like what actually happened with the bank failures and how the different banks are different. So I think that it's important to watch that so that you can understand this. And then we also talked about, people worrying about their banks, like, okay, well, how do I know that my bank's not going to fail? And how do I know if my deposits are safe? Well, we cover, how you can kind of tell that and the difference between the big, large, banks versus the smaller regional banks, even though Silicon Valley Bank had a lot of assets, but I think they were like one of the top 20 banks, right, Trav? But
right.
Still, a big difference between some of the majors versus the smaller banks. So that will be good information for you. And also, we break down, how to think through FDIC insurance and how to protect yourself. Basically, if you have a lot of wealth, you need to protect it. And there are ways that you can do that and diversify across different banks and different types of account ownership. So we kind of chatted about that a little bit. So we covered a lot. It's a great interview if you really want to understand these bank failures on a deeper level and watch Travis break down a balance sheet, which was very fun because bank balance sheets are very complex. And he did a great job at helping us understand that a little bit more.
What, I guess, would you say, Travis, is the most important thing when you're looking at those bank balance sheets or when you're trying to figure out, is your bank going to fail? What's maybe one takeaway that we can talk about here before someone goes to watch that full interview?
Sure. Well, the one commonality across the banks that have failed so far has been a good old-fashioned bank run or deposit run. And a big reason for that is that these banks had deposit bases that were more likely to flee because they're heavily either uninsured or not being paid interest in a world where interest rates have gone up. So depositor flight and being able to look at the deposit side of your bank's balance sheet and determine how much exposure does this bank have to flighty depositors who may look to leave quickly. In this age of social media, as we've seen, Silicon Valley Bank, $40 billion worth of deposit outflows in one day last Thursday. And that ultimately led to the FDIC having to come in and seize the bank. And so, yeah, having a good hold on how insured your bank's deposit base is, as well as whether that bank has a heavy percentage being paid interest or not being paid interest. If you're not being paid interest, if you're uninsured, those deposits are at risk of fleeing quite quickly.
And are we going to have contagion? Do you guys have any predictions on this? Like, is the worst over or is there more to come?
I think there's still more to come in terms of the rolling fears, the rolling share price declines. We've seen a ton of volatility already this week in banks. We're seeing today a lot of that worry spill over to the other side of the Atlantic with the European banks, particularly Credit Suisse, which has been a troubled bank there for several years now. And so I think we're probably not at the end yet. And the Fed and the FDIC and the federal governments are going to do everything that they can to try to stem the contagion and keep it from becoming this bigger issue like we saw in the GFC. And I'm hopeful that we'll be able to avoid that worst case scenario. And there's a few reasons why I'm hopeful for that. But again, I don't think we've seen the end of this whole episode.
So one thing that we've seen, and great response, but one thing that we've seen is just a hard reversal in the projected federal funds rate into the future. Just if you guys go back and look at last week and the prior week's episodes, when we show the Fed watch of the Fed fund futures, where you can see the projection of rates, we were looking at, I believe, well into the 6% range. And now by the end of the year and into 2024, the projection is that they're going to be cutting back into the low threes. And also, if we jump over and just take a quick look at like the 2-year bond and, on the short side of the curve, I mean, just here on the 9th. So what day was that? That was last Thursday, where we kind of topped out over 5% on the 2-year. As of today, we had a low down into the 3.7% range. What a massive, massive move. And so my question is, if these rates do come back down that quickly, does that stem the contagion? Does it really not affect it? Does it make it worse? What do you guys make of that?
It does help. It helps because one of the reasons Silicon Valley Bank failed was they had this big portfolio of what we called held to maturity securities. And really what that was it was longer term government bonds that they had bought when interest rates were super low. And those bonds had taken a haircut in value when rates rose. And there was a concern that Silicon Valley Bank, because of the deposits outflowing, we're going to have to sell those assets at a loss and essentially wipe out their equity. And the held to maturity portfolio issue is an issue at some other banks. Some other banks also have large portfolios of long-dated government securities that are underwater. But as rates come in, they move inversely to bond prices. So as rates come back down, those bond prices go back up, and the potential losses on these held to maturity securities actually narrow somewhat for these other banks. And so it does actually help theoretically on some banks to reduce the potential losses. Now, does it stop depositors from fleeing? Maybe not, but it certainly would help with the optics of the asset side of the balance sheet.
Yeah, and we saw bank stocks just take a massive nosedive. I think it started, Friday and then into this week. And Nikki, you tweeted the S&P Regional Bank ETF. What's this ticker?
It's KRE.
KRE. Okay, I'll pull that up. But you pointed out that there was actually an inverse relationship where when this dump happened, Bitcoin actually had an inverse relationship where it kind of ripped off of that. What do you want to mention about this?
Yeah, well, I heard some people argue that this rip in Bitcoin's price happened on low volume and therefore maybe it shouldn't, or like a thin order book, basically, which I don't know if that's true or not because I didn't look close enough. But they argued essentially that that's why Bitcoin moved so much, and that move in Bitcoin higher wasn't or shouldn't necessarily be contributed to people fleeing to Bitcoin as a safer asset over fiat because of these bank runs. I strongly disagree. I think that the move in Bitcoin's price, how it went higher, was definitely part of that narrative that people were freaking out about fiat at their banks, and they were fleeing into what they know of as the only true decentralized currency. And so I do think there was a sentiment shift in Bitcoin, and that's why it moved the way it did, right? So I don't know. That's my take on it. I think that it's very clear that Bitcoin has had these moments. We're looking at Bitcoin just following the NASDAQ and the S&P 500 for a very long time, and that correlation was very strong. But Bitcoin does kind of continue to show time after time, when we had inflation spike and, the money printing, and now we're having banks failing. There have been times where Bitcoin does move short term very negatively correlated, and it's as an outlier. And that tells you that in those moments, the sentiment is showing itself, right? And in this moment, people are saying, I'm afraid of the banks. I'm afraid of my money being at the bank. And I want to be into a currency that's not controlled by somebody, right? So that's kind of my take on the whole thing. Other people may have other opinions, and it may not last long. The Bitcoin actually showing strength right now compared to the weak indices, it may not last long, that negative correlation, and we may go right back to, the two moving together. Very possible. It depends on how long this lasts with these banks, but it does in a way just show you, like, sentiment was already bad with banks in the 2008 financial crisis, right? Like, we were still dealing with, especially millennials, having a lot of distrust in the banking system and in banks after what they saw in the 2008 financial crisis. I mean, all generations, right? But essentially, I think people were already struggling, and this just made it that much worse. And Bitcoin's price kind of reflected that sentiment, in my opinion.
Yeah, I completely agree. I think there's a few things that came together at kind of at the right time for Bitcoin. I always say charts are truth, right? Like, a lot of times you can see the news, you can see the emotion reflected in the price action. And so if we jump over to the Bitcoin chart here, I'll just do some analysis and we can talk about kind of methodically, like, what happened here. And I did a video on my YouTube channel where I walked through my recent trade alert and why I bought. I mean, I almost low ticked price here into the 19K area, and I was scaling into this panic. This was on the 9th. So last Thursday, Bitcoin had a big pullback when this stuff was really starting to surface. And I saw there was kind of a knee-jerk reaction, like a fear-based reaction to what was happening. And it just so happened to line up with what I was waiting for, which was a pullback after prices started to kind of shift from just an extreme bear market. And we've started to see signs that we're going back into bull season. Now, I say signs because it's not guaranteed, right? We're still, as of today, not able to get a daily close convincingly above that 25 to 26K resistance level in Bitcoin. So we're still not out of the gate, but we have seen the first signs of market conditions potentially shifting here. And so what happened was Bitcoin pulled back, the banking situation happened, and what we saw was kind of a flight to safety where people sold out of alts. And there's also news with Binance that, there's basically a lot of contagion risk in stablecoins right now. And I've said this many times, like, I'm a fan of the idea of stablecoins, and I know they have their own place in the ecosystem and they have real world use cases. But I am not comfortable storing a lot of my fiat value in stablecoins because of that counterparty risk. And people make the argument, well, yeah, you also have counterparty risk at a bank, but I think there's more counterparty risk having a stable coin than just fiat currency in an FDIC insured bank account.
And regulated bank account.
Regulated, right. And I do spread things out where I try to keep it below the 250 or 500 limit. And I like having that on ramp where I can quickly get cash on and off of exchanges. But yeah, that's basically what happened is we had the culmination of people panicking out of bank stocks and panicking out of stable coins into Bitcoin and panicking out of altcoins into Bitcoin. And I'll just show you guys, if I can pull this up, I'll show you a watch list that I posted where I was showing just kind of the relative strength of Bitcoin compared to alts. So this was yesterday. I said, yesterday alts were getting a bounce, but Bitcoin was leading the pack as far as gains over the past 24 hours, 7 days, and 30 days, right? And this is typically what happens early in the when market conditions start to shift from accumulation ranges into an early bull market, is you start to see Bitcoin attract the capital first, right? We see money come in, Bitcoin pops, and then alts either sell off because people are dumping shit coins or scam coins or just dead projects back into the Mac Daddy. And then after Bitcoin has a run, then you'll start to see large cap alts like ETH and some of the others that start to get juice. And then eventually that capital tries to find alpha and it trickles on down to other smaller alts. But we've also started to see, and this was just a snapshot for you guys watching the video of how intraday yesterday, Bitcoin was up, call it 6%, kind of midday. And then the total 2 and total 3 indices, which really what that shows is just all the total market cap, not including Bitcoin for total 2, and then not including Bitcoin and ETH for total 3, how Bitcoin was still just outperforming alts. And that's why I've just been so conservative with trying to trade alts, because I know the market conditions we're in, and kind of early in the cycle like we are now, it's just alts will underperform Bitcoin initially. And then when you're kind of midway into the bull cycle, that's where you can see alts start to outperform Bitcoin. If Bitcoin goes up, say 30% in a week, you'll have some alts that are up 200, 300% in a week, right? But over a long period of time, all alts, at least where we are over a decade into this crypto experiment, all alts have underperformed Bitcoin. And I expect that to be true until we get evidence that it's not.
It's really interesting because I think Bitcoin is finally looking like it could play the role that a lot of Bitcoin supporters want it to, in the sense that, financial crisis hits, banking sector concerns, and you've got flows into Bitcoin. Maybe a lot of that, like you said, also exacerbated by what happened with Circle and USDC having some exposure to SVB. Even these stable coins are sort of a bridge to traditional banking. And so as you see that Bitcoin performance, it was really heartening to see that as a supporter. So I think that's really notable. And I think it's also worth thinking about the broader questions, and maybe more people are thinking about these broader questions now of what are we really doing when we're putting our capital into banks? This banking system that's existed for hundreds of years, we're inherently, when we're depositing our funds for safekeeping, allowing those to be leveraged to be put into securities and loans at the decision-making of a handful of people probably at the bank, or a team of people at this bank. And we've seen time and time again that a lot of risk managers, a lot of teams at banks do stupid things to try to earn higher returns for their shareholders. And so the idea that to have access to our day-to-day funds in life, we have to put it with a leveraged financial institution that's making decisions we can't control is kind of insane when you think about it, right?
Yeah.
So I think a lot of people are finally waking up to that idea now. Hopefully that gets more attention.
I don't even know if most people know what's going on at a bank. Like most people every day, people that are in the markets, they understand this a bit more, but I don't think most people even know what's happening behind the scenes at the bank.
Yeah. And that's what I think, I'm trying to think a couple weeks out, right? Because we live in this world where we're dialed in all day, every day. This is what we do. We're professionals, right? This is how we make our living. Your average person that's going to work, they've got their own problems. And maybe they hear something about a bank going out of business and they're like, okay, well, that's not going to affect me. Most people aren't going to take action or even know what to do until it's way too late, right? Like say there is a situation where there is contagion and multiple banks start failing. Your average person is going to get really fucked up by that because they're not going to be quick to act, right? Mm-hmm. And I guess like most people, I don't know what the number is, but the average person probably doesn't have more than $250K in cash in an account. So maybe most people wouldn't be harmed by it unless the whole system came crashing down, which FDIC wouldn't stand a chance. I mean, they've got enough capital for what, maybe 1% of deposits. It's a weird thing to think about.
The question now is like, at least on my mind, is do banks get comfortable? Because the Fed is there to backstop them. The government could be there to backstop them. Like, at what point will banks be afraid enough to like do the right things and make sure that, you know, they manage risk well. Smaller banks I'm talking about. Because like now we know after 2008 and now that like the Fed will be there or the government could be there. So I guess at what point do people take advantage of that is my question.
I doubt that the bank management teams are looking at that this week and saying, yeah, let's just take risk. The Fed's got our back. But I think that's a real question longer term as banks get out of the crisis period and they start to explore ways again to increase their returns and increase their net income. There's always going to be that push and pull, that push after you get out of the crisis, that push to earn more again. And so that, again, it's just kind of a flaw of the system we have. And it's worth thinking about other models. And it's like, well, is there some model where people would be willing to pay higher fees to have their money in an account that's not leveraged the way that a bank leverages it? Or, you know, is there some way to utilize a crypto ecosystem to have funds on chain and to be, you know, quote unquote safe? I mean, I will say the one thing about Bitcoin is that if you store your funds there, you're taking on pretty significant price risk. And so it's not, it's not a perfect solution either in its current form, but I think it's worth people exploring those solutions and figuring out what makes more sense than what we've got.
Yeah. I mean, no matter where you store your assets, you're taking on some kind of risk. It's either usually counterparty risk where you're having to trust someone else with your funds, or it's volatility risk, right? When you self-custody an asset, like even gold or, you know, Bitcoin or collectibles or any kind of asset that you can hang on to, you're usually taking on volatility risk, right? Now, gold is a lot less volatile than Bitcoin, but it also hasn't grown nearly as much over the past several years as Bitcoin, right? So choose your adventure, choose your poison, right? I think that's why it's important to diversify and to just, you know, accept the risk, right? We're going to take on risk in some form or fashion. Just know what it is and accept it and like plan for the worst and then hope for the best.
I guess there were two things that kind of made this like an outlier situation. Like assuming all things equal and people go on with business as usual and they have their money in the bank and the bank's conducting business. It's not like they were doing crazy things, right? They were investing in they were investing in what? Mortgage-backed securities and long-dated treasuries, and really interest rate risk was not was the problem, probably more so than anything. But I guess what I'm trying to get at here is, fuck, I lost my train of thought.
That'll happen.
All right. Well, we're going to keep rolling.
I lost my train of thought, but keep rolling. It'll come back to me and I'll be like, oh yeah, that's what I was trying to say.
Oh man. Okay. Well, I want to pull up something that our friend Colin just posted. I like that he posted all of the.
Sorry, I want to get this out. So basically, they weren't like doing crazy things, but the two things that were the issue was the social media bank run, right? The social media pushed bank run. If people didn't do that and they didn't run to the banks and pull their money out, then things would have been business as usual. And then two, the Fed and how quickly they raised interest rates. That's what really kind of was the kicker for these banks and their bond portfolios going under in terms of value. So really it was kind of a little bit of a, I don't want to call it like an outlier situation, but it was the perfect storm, if that makes sense. The Fed raising and the social media induced bank run, basically.
Yeah, and to your point, I mean, what I like about what Colin just posted today was, or I guess this was yesterday, he goes, there's a cheat sheet for debating SVB. And he listed all of the potential ways to point the finger, you know, and everybody has their own opinion about this, but it's like, one, the VCs caused the panic. No, the Fed caused the bond losses. No, SVB didn't manage risk. No, the depositors were burning cash. No, the fiscal policy caused the deposit boom. No, COVID made us all crazy, right? Like these are all the possible ways. And there's probably a little bit of truth to all of them, especially the COVID making us all crazy part.
I think all of this is making us all crazy.
Yeah, but I mean, look, at the end of the day, it's like, yeah, we can point the finger, right? And we can come up with narratives and who should have done what and who didn't do what. It's like, at the end of the day, like, yeah, it's a soup of weird shit that went down. And you just got to manage risk and hopefully learn from this, and we don't make the same mistakes going forward. But I really don't have faith that that's going to be true. Let's talk. Okay, let's do this. Let's jump into some price predictions, or at least some mental models that we can talk about looking at Bitcoin. I know a lot of people are trying to figure out what the hell is going on right now, and I want to talk about that because there's some really interesting things that I wanted to point out to our community at the Skill Incubator, and I'll go ahead and share it here as well. I ran some numbers or just some data based on prior market cycles, and I found this really interesting. This was a watch list I sent out this week, which was showing where we are. Like, here's the current big picture and some price forecasts based on prior market cycles. And then I start by talking about the current situation, right? So here's where we are right now. We've been in what I call an accumulation range in between 19K and 25K for several months now. We are currently sitting above prior cycles all-time market highs, meaning back in 2017, the market high around, call it 20K, we are currently sitting above that. And we're showing like almost like an inverse head and shoulders above the prior market cycles all-time highs. Right. We've also seen a 77-ish% drawdown from all-time highs, and we've seen a market structure shift. And what that means for me is we've started to make higher highs, higher lows, and we are now above both moving averages for the first time in quite a while. So that's the current situation. You know, we are potentially getting ready to go into a bull market. And this is why I think that's the case. What I did is I ran some numbers and some dates based on the two prior Bitcoin halving cycles. So in 2016, which I didn't do the first one because the markets weren't as liquid, but I looked at 2016 and then 2020, and the next halving is, as of today, is looking like the end of April 2024. Okay. So here's what I looked at is I looked at how many days did it take from where the market bottomed to the halving, because typically what will happen is the market, Bitcoin's price will bottom out several months prior to the halving actually occurs, because people will buy in anticipation of that, right? And then I also looked at how many days after we break out of that accumulation range to the halving. And then one more thing I looked at is after the halving actually happens, how much longer do we have until the market cycle tops out and we go back into a bear market? And so the prior to halving cycles are actually really similar. 2016, it was 540 days, and 2020 was 513 days from the pivot low to the halving. So call it, 500 to 550 days from where the market bottomed to where the halving occurred. And then the accumulation range breakout wasn't so clear. 2016 was like 254 days. 2020 was 405 days. But after the halving on both of these, we had a little over 500 days of bull market until markets topped out. So 2016, it was 528 days. 2020 was 547 days. And then I added some charts here where I ran that. So here's what that means for potentially for the future. The current pivot low that we have going back to November of 2022 is currently around 15,500, give or take. And that is about 524 days prior to the next halving. So that's in line with the prior to halvings. Hang in there with me, guys. We're almost there. I know this is a lot of numbers. That would mean that the expected accumulation range breakout could occur anywhere from next week, March 19th, through like mid-August. So we could flatline. We could either break out next week, or we could flatline and then break out of that accumulation range into August and still be in line with the prior to market cycles, right? And then I go on to say, like, obviously nothing is guaranteed, but based on these prior cycles, we're on track. And granted, there are some caveats, there are some, but what ifs. The biggest one being Bitcoin's tracking of the stock market and the fact that Bitcoin hasn't really lived through an extended recession or extended bear market in the stock market because it was born at the bottom of the '08 GFC, right? So I think right now is probably the most important time in Bitcoin's history because it's setting up to potentially go into this next halving. If it does, I think it fulfills its duty, what it's designed to do. If it doesn't, then something is probably shifting there where it's either losing favor or the market is truly bringing it down and Bitcoin proves to just be another risk asset, just like stocks. But I don't know. I think this is go time.
It's pretty interesting how those numbers line up so closely from all the different cycles. It's kind of spooky in a way.
Yeah. It's almost like a self-fulfilling thing, right? Mm-hmm. And the whole disclaimer that we typically see in the markets is past performance doesn't predict future performance, right? That's why, like, when you backtest a strategy, what would have made you a bajillion% in history, if you try to apply that in the future, it may or may not work. Usually it doesn't because markets change. But it's weird because Bitcoin is driven by this narrative of the halving and limited supply and shrinking future supply. And so therefore, it's kind of like a self-fulfilling prophecy. And I don't know, I'm riding those market cycles and I'm trading them as long as it's true,
Yeah.
We'll see what happens, but that's my thesis.
Good detective work right there.
Yeah, I'm just a nerd for this stuff. And I think it's just so interesting that these dates are kind of correlating with all of this macro Fed inflation, recession, all right, all these narratives, all this noise, all this fear. Will Bitcoin shake it off and just continue its trek forward, or will something throw it off? That to me is the $300 trillion question.
We're wondering that about stocks too right now.
Yeah. Let's talk about stonks. So we did a little bit of looking at Bitcoin's price action. As of today, stocks are still around Nikki's trend line of doom from last week.
They're hovering under the trend line of doom.
They're hovering. Yeah, it's like the S&P 500 right now is below the moving averages, but hanging on to the trend line of doom, where the NASDAQ, primarily tech, right, is still above both moving averages.
I have my trend line of doom drawn a little differently than you do, I think.
Okay.
Maybe not. Okay, so we're under. Yeah. Okay. No, it's the same, but we're definitely hovering under the trend line of doom, and in between that nice cross of the support and resistance trend lines combining. So yeah, I think that right now the market is. I'm actually surprised the market's not down more, to be honest.
Same.
I'm surprised that price is this strong. I think a lot of growth stocks are actually showing strength right now.
Like which ones?
Which is a whole nother conversation. I mean, I was just looking at something like Shopify, right? Like Shopify's holding up, consolidating, holding up, potentially a secondary breakout. And then you got like Meta, which Meta kind of has like a few different things going on. And I don't know if we can call it a growth stock anymore, but it's bullish right now.
It's crazy that it's doubled since November.
And this could have a lot to do with possibly banning TikTok. But, there are plenty of charts that I came across that I was like, how are these charts up right now? Even like Squarespace is up.
Well, isn't Facebook laying off another 10,000 people and they're focused on profitability now? Or what's the narrative there?
Yes. And that was like Travis and I's thesis like last year. And that's why we ended up buying the stock, because we knew all they had to do was do a few things and boom, free cash flow flowing. Right. So, but the point is I'm surprised that a lot of these names are still up, still showing strength, holding some of their gains. And I'm surprised that the broad market is holding up the way it is. What is it going to take, Travis, for this market to crack at this point? Because now you've got people excited because they think the Fed's going to slow down rate hikes. which is good for stocks in the end, but that also could mean like a recession. So we're still sitting here just wondering what the hell's happening and what's going to happen in the future.
I feel like it could be death of 1,000 cuts. It's just going to be a long, slow, grinding bleed out for stocks over the next 6 to 12 months.
What's it going to take?
Yeah, I don't know why NVIDIA trades at 20 times sales and over 50 times earnings. I don't know why Google's up over 2% today when there's concerns about global banks. I mean, I can't tell you. It's kind of crazy to me, but maybe a lot of people see safety in big tech with, strong net cash on their balance sheets. Maybe they're thinking there's just not a whole lot of other places to put that capital at the moment. But yeah, for me, I'm kind of glad that, I went into cash and bonds heavily over the past few weeks when we were getting over 5% yields on short-term securities. I'm just going to chill and wait it out and see if we do get deeper pullbacks, because I don't see a reason to chase right here, right now with this current set of market conditions.
Yeah. And the technicals are hanging on by a thread. I mean, if you look at the S&P 500, it's not going to take much for this to break down below 3,800 and boom, we're back at the lows from last year. So we're hanging on by a thread for sure.
Yep.
And then I guess what is y'all's prediction for next week? What is it? Yeah, it's next week that they're doing the next Fed announcement, and the probabilities have just been all over the place, but it's almost 50-50 now between 25 and 50 bips, right?
This has been wild to watch, by the way.
No, Chris, by the way, that the probabilities have shifted to 50-50 of no hike and 25 basis points.
Oh my God.
Yes.
I know that sounds crazy, but that's where we are. We were pricing like 80% chance of a 50 basis point hike at the beginning of last week. Now we're pricing a 50% chance of no hike and like a 50% chance of only 25 in 1 week.
Tells you, no one knows what the F is going on.
Oh yeah, I didn't even notice. It's funny. I haven't even given that any thought, but it's true. It's like, yeah, we're all of a sudden we went from, oh my God, rates are going to go up forever to capitulation here.
Now, I wonder how much of crude oil declining, oil prices going down, could be affecting stocks' resilience as well.
Yeah, oil's down pretty massive this week.
Because this means more disposable income, essentially, for consumers, right? In a nutshell, if you want to like give it a broad paint stroke. That's what I'm seeing. So
we also got CPI that was in line with expectations, continuing the trend of cooling. Just what was it yesterday?
If you believe the official numbers.
That's right. And PPI came in below expectations as well, the producer price index. And now if you look at the Cleveland Fed nowcast of the March numbers, we're only halfway through March, but they published those preliminary estimates, and it's down to 5.22% prediction for the March CPI. So it looks like there is good news, at least in the official figures. Who knows what the real numbers are, but the official figures at least are looking like they're going to be coming down. We also know that the owner's equivalent rent, or the shelter component of the CPI, which is a lagged component that takes 12, 18 months before home prices decline, or 12 to 18 months between when home prices decline and when you see the deflation in the CPI shelter component, there's a lag there, and that will start to weigh on the CPI come June. So around the June timeframe, we're going to start seeing heavy pressure on the CPI, downward pressure on the CPI for the first time in a while because of the lagged rent component. And that's going to make for an interesting situation. And I think that's why, again, we've talked about how we think the worries will shift from inflation to concerns about recession here. And I think we're really on the cusp of that now.
Riding that tightrope.
Yep.
Man. Okay. So I think we've covered quite a bit about the Fed and markets. Something pretty cool that happened this week is ChatGPT 4 came out.
Yeah. And
people have been posting all kind of just really cool use cases, but something that's, I don't know, this is like almost scary. GPT-4 passes basically every exam, and doesn't just pass. It's like mastering, like the bar, the LSAT, like pretty much like all of these statistics, or all of these exams. It's just blowing out of the water. And I said, RIP legacy education system. I mean, this changes everything in a way.
Hey, listen, I still beat it on SAT scores and GMAT scores. Wake me up when it's doing 99 percentile on math. No, I'm kidding.
Okay.
No,
it's on the CFP exam.
Right. I mean, it is impressive. It's incredibly impressive. And I want to play around with GPT-4 some more, but yeah, there's a big shift that's happened. And I think we probably haven't even begun to scratch the surface on the longer term implications, even the medium term implications of what comes out of this, amazing development with artificial intelligence. So yeah, I shouldn't downplay it too much. I have to poke fun at it. Although this time next year, I'll probably be apologizing to it and asking for forgiveness.
Right. You better bow down to your overlords, because they will be our masters here very shortly.
What is the major change between the prior release and the ChatGPT-4? Like, I'm not up to speed on what the
my understanding is it's trained on exponentially more data, and they fixed a lot of the issues. Like before, it was giving just really incorrect answers to like super basic questions. And I've seen just also modalities, like it can do like it can read pictures now and interpret pictures and create you can basically draw a mock-up of a website on a piece of paper, show it to it, and it'll give you the code for it. It changes a lot.
Got it. Also,
another thing that's coming out, I think this week or next week, is Midjourney version 5, which is nutty. If version 4 wasn't already good enough, version 5, like I think this is going to crush Instagram, because the flood of just pictures that are really difficult to tell if they're real or not. Look at this. They fixed the hand issue.
I was going to say, what's up with the hands now?
Yeah. Version 4 was like a train wreck. Look at this. This is gorgeous, man.
That's wild.
These pictures are just almost lifelike at this point. And to see where they came, like from version 2 and 3 to this stuff, this is nuts. Like, look, this rapper looks absolutely real to me.
Yeah, I would have assumed that was from a concert picture.
I know.
Sure, that's not like a concert picture it took.
I mean, it could be,
because that looks real.
I don't know. Yeah, I mean, look at this tiger. It's nuts. I can't get over it. That's like wild. This also changes so much. This is funny.
Look at those hands.
Yeah, dude. I don't know, man. It's just I'm gonna have so much fun. I've gone through and done. They've had everybody go through and do some testing where they'll show you different images and you choose which one is better than the other. I guess they're trying to get it dialed in or something, but I don't know. I'm just so impressed. I went down the rabbit hole and spent way too much time in Midjourney, but it's impressive.
I will say you did spend a lot of time in Midjourney.
I'm like, it's 2 a.m. I'm like, what am I doing here?
Dang, that thing must be good.
Yeah. Hey, there's potentially significant returns to be had from being to being early to these tools and to actually getting to proficiency with a lot of these tools, I think.
Yeah,
absolutely.
Sure.
Time not wasted, hopefully.
No, I don't look at it as a waste.
As long as you had fun, that's all that matters.
Yep. Awesome. All right. What else did we have on the docket for this week? I know we're not doing any questions this week, but just wanted to talk a little bit about the AI advancements. Anything else on you guys' mind? I know the past week has been kind of a blur. I was on Twitter Spaces for like probably 12 hours over the weekend, just listening. And Trav and I got on some to chat a little bit about what was happening. But it's one thing that has been kind of solidified in my mind is like Twitter. I don't know. It's become my favorite social platform. It used to be one of my least favorites because there were so many trolls and like just idiots there in the early crypto days. But I kind of like the direction that it's headed. And I know Twitter's like super political and a lot of people hate Elon and, you know, all the controversy around it. How do you guys feel about Twitter now versus maybe even just 6 months or a year ago?
I can't live without Twitter.
Same. Yeah. I spend a tremendous amount of time on Twitter because I put a lot of work into it. I've got a lot of lists that I follow that I put together of accounts that I follow for finance news and analysis. And of course, Twitter Spaces, like you said, we've been utilizing a lot. I thought it was really interesting over the weekend. all of the Twitter spaces, some of the bigger ones where they had 15, 20,000 people, and people like Mark Cuban and Bill Ackman were coming on to speak and give their insights. I don't think we've had a platform like that before, where we got to hear directly and ask questions directly from a lot of the people that make headlines, and, you know, billionaires that make big decisions. And so that was really interesting. I was a little frustrated at times. I thought there were some times where people were just getting up to speak, that were allowed to speak, that didn't really have a clue of what was happening, and they were just rambling, or they were giving wrong figures. And I was like so frustrated. I wanted to like, please add me as a speaker so I can give context to the actual numbers and what's really happening here underneath the surface. So sometimes there's a lot of noise there. I think you have to find ways to separate the signal from the noise on Twitter. And a lot of people have problems doing that. But, you know, I think if you kind of learn the platform, it can be really, really powerful, especially for like breaking news and following like really niche communities.
Yeah, I agree. It's you definitely have to vet your sources carefully, right? Yeah, I heard some people on some spaces that were just trying to get in front of, you know, at some points like 20,000 people. And yeah, you've just got to be able to filter, and not every day is going to be a, you know, a 5 or 10 hour day on the spaces, but I'm going on a space in like an hour, so I got to run pretty soon. But yeah, okay. What else are you guys looking at this week before we wrap it up?
Just trying to keep our sanity in stocks for sure.
You know, there's just been a lot to keep up with.
Yeah, we're gonna keep an eye on the rate moves. Of course, we, like you said, have that big Fed meeting, and they'll announce their decision next Wednesday. That's going to be very pivotal to what happens in the market. But I'm looking to buy the dip on some of these energy companies. You know, there's a stock that's down 10, 12% today that I think is really interesting. And, you know, if you believe in the longer term supply, demand, and balance in energy, certainly some values could be starting to emerge there again. And really looking for, you know, any clarity on what's happening around the issues with the financials, if we see things get worse or if it starts to fade away. And yeah, just trying to keep an eye on price action across all these different asset classes and across sectors of stocks as well. Yeah, it's a good time to be in the markets, focused, watching what's happening, and making sure you're listening to the right people who know what they're talking about.
Speaking of that, I was curious yesterday. I was like, I wonder how people are doing. And anytime I wonder how my followers or people that I'm connected with are doing, or what they're thinking, that's another reason I love Twitter, because I can just send out a survey. And so sent this out. I said, how are you doing financially? And I said, be honest, because it's anonymous. And almost 50% of people said they are thriving and building wealth.
Wow.
So that's really good. I wasn't expecting it to be that high. But conversely, about a third of people, so like 35% of people, said they're just getting by and they can't invest. So basically, you know, how I think about this is from a cash flow standpoint, right? It's like, if you have extra cash flow at the end of each month after your bills are paid, you can take that and you can invest it, right? That's what I consider thriving. At least it's like you have money that you can use to build wealth and stay ahead of the inflation monster. If you're just treading water, that's more difficult, right? And then about 15% of people said that they're either more in debt each month or they're ruined and starting over. So for anybody in that situation, I'm sorry to hear that. You know, we've all been there at one point where we're just either drowning or having to throw in the towel and start fresh. But, you know, for you guys that are treading water, I know the inflation piece has been a difficult thing, right? With rising cost of real goods. And I did a video on my channel yesterday just talking about, and really it was a reaction to a guy that was working really hard, had a 6-figure income with his wife, and they could barely afford like a dump. And with rates high and with real estate prices still close to all-time highs and inventory low, like, yeah, a lot of people aren't really able to get ahead right now. I just thought that was interesting. And it's encouraging to see that half of people are doing well, but I also want to, I don't know, think about how we can help those people that are treading water or starting over.
Yeah, I think that inflation is definitely, I mean, I talked to a lot of people, and inflation is affecting just about everybody that I talk to. It's when you go to the grocery store, you feel it. It's a lot. So I can see why a lot of people, including retirees, people that are, you know, on a fixed income, are struggling right now. But I think that there is light at the end of the tunnel that we can kind of see with a lot of this settling out, because this has been, since COVID started, the whole thing has been just a whirlwind. And now we're having to recalibrate and kind of get back to whatever normal is supposed to look like. And I think it's starting, and people are going to feel that. Fortunately, you know, the labor market continues to be strong too, and that helps. But the real estate market is just insanity. I mean, the prices just aren't coming in enough. And Chris, you touched on that in your reaction video on your YouTube, how that person couldn't even afford a home. It was like, what, a $400,000 home?
He didn't say the price of the home, but I know the mortgage industry really well, and I backed out the math, and I said, okay, based on what he's saying, his take home income, he can quote unquote comfortably afford 400,000. And I guess in his community, there was like one house that was in that range that was just a complete dump.
Be California, or
it could be, but you would be surprised. Like there's even places like, you know, populated cities on the East Coast. Like I've heard things about like Raleigh and places in Florida where it's like there is nothing in the $200,000 to $300,000 range that a self-respecting human wouldn't live in. Even our buddies in Tampa are saying, like, you know, the average house now in one of those cookie cutter communities that I hate, they're $500K and up now. So
yeah. And this is what I was talking about before on a prior show, how housing prices are going to have to budge more for people to be able to get in with interest rates where they are. So something's got to give somewhere. And hopefully it does, between rates, inflation, housing prices, the combination of all of it together is what, you know, we hope can help people.
All right. Well, guys, let's see. How do we wrap this up? Let's tell everybody to go to wetalkmoney.com, submit a question for the show. Also go to wetalkmoney.com/community to check out the wealth building community. Leave us a review on any podcast platform. Subscribe to the new YouTube channel here. It's just youtube.com/wetalkmoney. And yeah, we'll see you guys next week. Take care, guys. See ya.